Welcome to Impact TV, a corporate venture video series in collaboration with the Kaufman Fellows. I'm Jack Crawford, a founding general partner at Seracap Impact Venture Capital, and alongside my colleague Pat Bumpus and my Kaufman Fellow co-chair Alessandro Santo, we're thrilled to welcome to the show Terry Doyle, managing director of TELUS Global Ventures. Terry, how's it going?
Good, thank you, and so very kind of you to invite me onto the program. Thank you.
Well, now that you're on the GCV power list for top 100 CVCs, it just made sense to bring you on. Congratulations for the award.
Thank you. I appreciate it, and definitely in some esteemed company there. So really very lucky to be with such a great group.
Our audience always appreciates sort of understanding sort of the personal journey of how you got into corporate venture capital. And I know you've done some travel from London to Silicon Valley. You've spent a little bit of time at Nokia and Microsoft. Tell us a little bit about your journey along the way to TELUS Global Ventures.
Well, I should start by admitting that I'm a recovering lawyer, and I figured out very early on after I finished law school, I did a couple of law degrees, that the world did not need another unhappy lawyer. So I made my way into business development, working with startups in the first bubble, and quickly figured out that I should probably do some corporate development. So I did corporate development, as you mentioned, both in Canada, in the UK, and laterally in North America and in the US. And so my career has sort of taken me all over the world, in Asia, South America, and Europe mostly. And really just because of one role, particularly with British Telecom, they were really happy with my deal skills, buying mostly public companies, and said, "Hey, would you move to the U.S.? You can be wherever you want to be." And so I chose the Valley because I wanted to be a little closer to what was going on. And since then, have been sort of evolving as getting more and more involved with the startup community. I worked for a high growth startup called Checker, which was automating background checks in the Bay Area and for large gig economy customers, and then started doing some investing on my own. So it's a real mix of transactional strategy and startup focused on technology companies. So when TELUS was looking for a new leader for their corporate venturing fund, they happened to have a Terry-sized hole, and I was Terry, so fit perfectly.
TELUS has a bit of a global brand, familiar to some, maybe less familiar to others. Maybe to start at the high level,
Yeah.
tell us about TELUS, if you will.
So we started out as a telco. You're all familiar with them. We've evolved, I'll say, into a global technology and services business. Maybe unlike some of our competitors or even folks in the U.S., we wanted to diversify the revenues of the business, but instead of going into content or entertainment, we decided to focus on, I'll call them, value-added service verticals. And so those verticals allowed us to leverage our network expertise, but also get into, I'll call them, bigger margin, wider margin businesses that were less regulated, that we could use some of our expertise to do well in. So we've gone into areas like digital health, digital agriculture, smart cities, smart consumer, a lot of every sort of variable of IoT. And so the business is quite diversified now. And though the core is still telecom, we're evolving quickly into, I'll call it a multinational in a lot of different spaces.
It's super helpful. And so TELUS Global Ventures is not just providing funding. I think you have a line sort of turning concepts into market realities. And I wondered, I've seen corporates provide support with product development, support, being a customer and sort of commercial contracts, sales channels. Sometimes they'll establish a sales channel for a startup. Can you just talk a little bit more about sort of how you think about turning concepts into market realities?
Yeah, we definitely recognize that there's a place for us in the evolution of a business. We focus on a couple of things, and I always like to be transparent. What motivates me and my team: we are strategic investors, and that means that our job is to push the product roadmaps of our various business units, and we do that by doing business with them. So I think, like some folks, we have a measure which is quite important to us. We call it value creation, and the easiest way to think about that is our portfolio companies either selling to us or through us. So if they sell to us and we reduce our OpEx, we capture that value. We sell through and we have a margin on top of the selling. We capture that as well. To give you a sense of scope, we did 73 million in business with our portfolio last year. So lots of CVCs have what they refer to as an attach rate, meaning do they have a commercial deal with the company when they put a check into the business as an investment? Our attach rate is around 80 to 90%. Industry best practice is sort of 40. So we're pretty good at it.
Oh, really good. Yeah. So in the corporate world, you have everything from, sort of Oracle, who was just in the habit of buying companies. My co-founder Eric Ball and I collaborated at Oracle. You have the direct investors and Google Ventures and some of the Salesforce doing direct investments. Yeah, you have some firms like SK Hynix that were LPs and direct investors. Is there something specific that you view sort of differentiates TGV from the rest of the marketplace?
Yeah, I mean, I'll say that we're in the distribution business. So an extreme example, but a good one, is we have a digital health business, more than half of which, we'll call it a $2 billion top line. More than half of that is employer-employee health benefits. We have, let's call it, in that part of the business, 110,000 customers who cover 150 million lives. So if I invest in a digital mental health startup like Unmind in the UK, the day after we invest, they have 150 million potential customers and a high degree of success in landing those customers. So we like to think of ourselves as we're a Series B investor, in that we want to be able to create a commercial deal with the portfolio company. We've learned through, I'll say, very painful experience that is a 20 billion US market cap business, or 28 billion US market cap business, us doing a commercial deal with a 10-person startup is miserable for everybody involved. We take them off their roadmap. We create customer dependency, which makes it harder for them to raise money later on. We really want to be investing in companies that are in that 5 to 10 million ARR, and we're able to both bring them insight from our customers that we have, but also distribution.
Can you describe a little bit more about how you're sort of adding value from, is it a pilot project that turns into a commercial contract that turns into, sort of distribution out to this, incredible audience you have? Obviously you're in a great position to provide efficient access to a channel and to literally a very significant global network, it sounds like, of customers. Maybe walk through, if a startup approaches you, how does that process usually evolve?
Yeah, it comes in very many forms. We're an active investor. In 2023, when most people were a little reluctant to write checks, we wrote 30. So we're very much in market. So we know we have a high degree of sort of variability across where we're putting money. But the core comes down to, we actually build the strategy with our business units. So build, buy, partner is actually agreed with the business units, and we develop it with them. I like to refer to it as the buy box. Everybody in the business unit knows, if we want to go into precision spraying and agriculture, we know exactly where we want to spend time, either partnering, acquiring, or investing. And so what that means is we have a very, very tight focus when we go out to market to invest in companies. And the benefit of that is, we either know we are going to sign a commercial deal, or we've already got one in play that we can then say, all right, we're going to invest in the business as well. It does happen in varying degrees. Sometimes we invest first and then, do a commercial deal or vice versa. There are a lot of factors that go into that. But the fact is, we either want a POC, a proof of concept, within the first 12 months, or a commercial deal. And we have the same people who helped build the strategy make sure that those contracts are actually fulfilled. This is one of the challenging things in being in a big corporate. The smallest business I invest on behalf of is that health business, $2 billion top line. If we do a $200,000 POC, it's kind of hard to get everybody's attention. So we have a number of levers, folks who are on the call who would sort of appreciate this, but not only do we do POCs or commercial deals, we actually give RSUs to product managers to make sure the milestones on those commercial deals get met. So we are juicing our returns by effectively saying to the people who are responsible for making those contracts work, you're going to get 30 grand in your pocket in order to make sure this thing actually works. And much like a super tanker, once you get it to work, then the momentum just carries the commercial deal to success. So it's a combination, but the core of it is really, we agree the strategy. It allows us to get to a commercial deal very quickly, and it means we can act and decide very decisively. Maybe unlike some CVCs who have an opposite model where they go out, find a great company, and they pull it back into the business, try to convince the business, hey, this is great. You should really, you should use this technology. We go out with a very clear view of what we want to do.
Proactive, it sounds like, and leveraging internal expertise. It'd be kind of interesting to hear a little bit more about the organizational structure and how you're leveraging these product managers. On our team, we have operating partners that have deep industry and operational expertise. Jan Geldmacher and John Hooker are on the call today that really have a deep expertise by industry sector. We also have venture partners like John Finnegan, who knows a lot about ag tech, right? 30, 40 years in the ag tech space. Is that similar to how you've been interacting with your product managers or your business unit managers by industry sector?
Absolutely. So we have about 20 people on the team, roughly divided in thirds. We have I'll call them the strategy and business development group. They're the ones who help build that strategy with the business unit and make sure that those commercial contracts get going and fulfilled. We have a portfolio manager. We got 82 companies in the portfolio, so we have somebody who makes sure that we sign things and make sure that we're on top of reporting all that. And then I have deal leads who really align with the business units, and they spend their time both understanding how the leadership of the businesses work, but also influencing them. I like to use the analogy that we're all looking through a lens at the market, and our job is to polish the outside of the lens. My business unit colleagues polish the inside, so we have a unified view of the marketplace. We tend not to have people they have specialization, but where we get the magic is when we have, I'll use that previous example in the benefits business, those 110,000 customers come to us and say, the three things that employees are asking for are digital mental health. Shocker, I've made a bunch of investments in that space. Neurodivergence, help with neurodivergence, and menopause. So we bring insight from our customers through the business in order to guide our investing activity, and then we use the subject matter expertise of those product managers and the customers to make informed decisions. And by the way, try to help the businesses once we invest.
Out of curiosity, the digital health example that you used, are you finding that in addition to sort of health and wellness, there's an internal interest in either continuous learning or coaching on the sales front? Is there ever a peer-to-peer coaching model or establishing a platform to engage with sort of outside coaches, particularly for those employees who maybe are looking to upskill or working remotely and maybe are less collaborating in the hallways? How do you think about coaching?
Yeah, it depends. We try to think of we're not the only source of expertise within the business. So as an example, like I think there's a lot of different ways to answer your question, but one is like, we, assuming there's no conflict, we bring people from the business units in to sit on boards. It's a great way for them to contribute to the success of the investment, but it's also their opportunity if they have, we all do this when we invest in companies. We look at a founder and they're great at product development, but they're weak on go to market. Cool. We happen to know a bunch about selling, so we'll bring in a sales leader who can really provide, I'll call it, guidance and coaching to the founders. We in terms of our product offerings, we don't do a ton of things on coaching, but in terms of health, we spend a lot of time thinking about longevity. So I guess it's depending on how you think about coaching. We know behavior change in the health space is super important, and we have a lot of investments in helping people make the right choices for longevity and good health. So there's lots of different ways to answer the question, I guess.
That's helpful. That's helpful. Last question on sort of structure. I'm assuming, although Sony has started to bring in outside Sony Ventures has started to bring in outside LPs, and certainly some groups are starting to look at an LP beyond sort of the corporate entity. Most, I think, still have a single LP. I'm assuming that's the structure with you. And if you could talk a little bit about, are you reporting up into the CTO? Are you reporting to the CFO, CEO? Maybe just talk about confirm sort of LP structure and then a typical reporting structure.
Yeah, so we invest off balance sheet. I have a single LP. He's my boss, the CFO, and some pluses and minuses. You get decision making can be very quick if you need it to be. But it also means that you can get a phone call at 6:30 on a Sunday morning asking very specific questions, and it's your boss, so you got to answer. I think there are pros and cons to having a single LP. We can deploy capital up and down the stack should we think it's appropriate. We can write whatever check we want. In certain instances, we started out with a smallish investment into a business and put $220 million into the investment because we could leverage our own balance sheet and really accelerate the growth of a company through acquisition. So we have a high degree of flexibility. We invest in other funds, mostly for geographic deal flow. So I'm based in the Bay Area. I've been here 20 years. As you would know, Jack, you've seen some tourist behavior, we'll say, buy high, sell low. This is really hard. Let's leave. So we don't want to be tourists in other parts of the world. So as an example, we've invested in a couple of funds in Western Europe. It helps us see deal flow. We figure out who's who in the zoo. We even like to see why they're saying no to deals. And then usually what will happen is we invest alongside them a couple of times. And then, in some instances, we've hired somebody through the fund. So for us, LP investments aren't about the return. It's about really getting access to deal flow that's good qualified deal flow where we can get smart in a geographic space.
Visibility to a new ecosystem, maybe where you don't have a physical presence and maybe don't have much of a network. And
yes.
So yeah, that makes great sense. And I've certainly seen that before. I also appreciate your comments on the organizational structure because it sounds like you can move at the pace required for success in the VC industry, and many corporates cannot. Right? It's going to take them 6 months, 9 months to get business unit sponsorship and approval from the CFO, and then approval from the CEO or the board level if the investment's larger. It sounds like you're moving pretty quick.
Yeah, I have to say that we all know if you're involved in CVC, the large risk that you have is change in management. I think Jim May out of Stanford has this great organizational behavior model where you think of exploitative behavior versus exploratory, and the two are always fighting within the business. Venture is exploratory, and we've all been involved in conversations where you invest $20 million into something and there's somebody in the business unit saying, I could really use that money for my own P&L. So you're always sort of a source of friction. We've had the same CEO for 23 years. We are coming up. This year is our 25th anniversary of TGV. So we've been at it a long time, and it's basically been because of that support from our CEO. And to refer to my earlier comment about 2023 and doing 30 transactions, his response was, "That's great, Terry. Now do more." So he thinks like a founder. He thinks like the founders that you and I are exposed to on a daily basis. And between him and the CFO, um, I would refer to the CEO as being the accelerator, the CFO as the brake, and I kind of got to live between the two of them.
Super helpful. Let's do a little bit of a deeper dive on your industry sector focus. You covered
Yeah,
digital health pretty well. It'd be great for you to comment on ag tech and IoT at
yeah,
whatever depth you'd like. John Finnegan is on our team and is the expert in ag tech. He runs a company called Beck Ag, which is really interesting. And then Jan Geldmacher, I mentioned earlier, he really knows a lot about IoT. So he brings a lot of intelligence to our team when we're thinking about IoT. So maybe a little bit deeper dive on ag tech and
yeah.
IoT for their
Yeah.
benefit.
Yeah, well, on IoT as an example, let's think about smart buildings. We are lucky to have great relationships with folks who happen to be looking for data connectivity. And so once you've got that relationship, your job is to sell up the stack. So as you go to somebody who's managing 15 large commercial properties, you can say, "Hey, like I can give you a dashboard from a company we've invested in called Kode, that helps give them visibility across all those properties, or HVAC control and monitoring, all the things." So it's really about an entry point, and then using that entry point to sell up into new services. And so we're part of that, helping facilitate that. And that's, by the way, the same in our consumer business. We have this anchor into 9 million homes that happens to deliver internet. Well, what's great about that is you can then deliver security services. You can deliver monitoring for aging in place. Baby boomers are getting older and they want to stay at home. How do you monitor mom? Well, you actually use services that are delivered through a gateway. So we like to think of it as like, what's our relationship to the customer, and how can we expand and grow that relationship? Ag is another one where I think a high degree of empathy is required, because you've got end customers. We're involved in multiple parts of the ag space, but the simplest way to think about it is we're trying to be from the shelf all the way to the farm and owning that data layer. And so we have investments in companies like Tastewise, which help people understand what's going off the shelf and why, and all the way through to helping farmers get better understanding about what they should be growing and how they can grow it more efficiently. The challenge at that end being, businesses with very thin margins operating on data that they've got to make a decision for a year and sit on and see if they're right. So a high degree of empathy for those buyers. But that's the kind of stuff we spend time on. We do. I'll refer to those. We refer to it as Ventures Plus. So that's the idea that we write a check and have a commercial deal. More familiar to other people is Horizon 3 type investing. We do some of that. It's about 20% of our investing, and that tends to be, again, related to our core business. So you'll have seen that we've made an investment in a company called Photonic, which is in the quantum space. And we think quantum is really compelling, not just because we know that we're going to be able to transport across our networks, but we're what the security folks like to refer to as a large attack surface area. So we're quite focused on cryptography and the assumption that much of the data has already been exfiltrated and people are sitting on it waiting to crack it. We're working with our customers to make sure that they're ready for Q day and that they have the right encryption tools in place. So that tends to be a little farther out, and we don't know when it's going to happen, but we know it's of interest to our customers and to us. And so that's where we're spending our time. I'm spending my time on longevity, quantum, AI. I can't believe I got this far into the call without saying AI. Um, and we have, in AI, we have a pretty large business. We have the second largest data labeling business in the world, with customers like NVIDIA and Google and Chrysler. And so we know that there's some places we can play, in everything from developing new models, observability tools, uh, agentic orchestration, where we spend time. But we also just wrote a sizable check into a self-driving trucking company called Wabi, based in Toronto, that's done the largest funding round in Canadian history for venture, about $1 billion, with Uber and Coastal Ventures and folks leading. So we're in a lot of different pies. We got our finger in a lot of different pies.
Well diversified across a lot of different opportunity sets and investment themes. Yeah, that's actually extremely interesting. You have set a personal record, Terry, 27 minutes into the interview before mentioning AI. That was impressive. So nice work. If you don't mind, maybe just double clicking on that for a second. Anything in the AI chip space or the data security space? You mentioned it a little bit. Tell me a little bit about maybe investments in that space. I mean, obviously Grok and NVIDIA just did a $20 billion deal. Cerebras is out there. I don't know, it's a $23 billion valuation forecasted. Series A rounds of financing in that space at 300 million. It's kind of hard to ignore. We have a portfolio company in that space, so we're paying pretty close attention. What's your sense on the AI chip space and sort of as it relates to maybe applied to security?
So we haven't spent much time in the space. I got to be honest. We tend to try to be asset light or low capital intensity. I would say where we care about, we sort of divide the world in AI with AI native versus AI enhanced. And so in areas that we're involved in, we're spending a lot of time on AI around health. So, everything from longevity, but also, creating better diagnostics. We have an investment in a company called QBio, which is doing full body scans and making those much shorter and more precise. So we care about, I should have said off the top, and it's probably relevant, like, we're a social capital company. We believe in using technology to better and improve people's lives. And so that's the lens that we look at all of our activity. And so for us, when we're looking at security, it's much more, I'll say, in agentic orchestration, where we're trying to prevent people from providing, too much information through an agent and having it exfiltrated by a bad actor. So for us, it tends to be higher up. It's sort of level 3, level 4 in the AI stack. And that's where we know we have, a good understanding of what the customer needs, but a good relationship with them to bring them something which is valuable to them, and the trusted relationship.
Awesome. Maybe last question on industry sector, and then I want to talk about sort of how you co-invest with other groups. Anything in the nanotechnology space?
Not so much. I mean, I'm trying to think. We've looked at a couple of things in the health space. We tend to be, again, like, mostly because we have such a large footprint in Canada where there's a single payer, we tend not to be involved in businesses that are end user payer friendly, we'll call it, so diagnostic. And so we have seen a bunch of things in the diagnostic space, in the health space, but not a lot in nanotechnology. No.
Okay. And now switching gears to sort of syndication of rounds of financing and your investment style. Can you talk a little bit about, are you typically leading the investment? Are you typically following? And do you like to take a board seat? Would you prefer a board observer seat? Maybe just sort of talk about your typical investment style when you find an investment that you're excited about.
Yeah. Again, to the comment I made earlier about having a single LP, we have, I have a lot of flexibility. So I think I keep using 2023 just because it's the one I know the best off the top of my head. 30 transactions, half of which we led, half of which we followed. Half of the ones that we led were new investments for us. So uh, we don't have like a preferred style. I say to the team, and it's the mantra that we use all the time, our job is to get the right amount of capital into the hands of the right people solving the right problems. And so that's our starting point. So we can be adaptable to, I would say the golden rule that I try to stay away from investing too early as a strategic um, in a company, because we want to make sure that the company has full sort of range of possibilities and that we don't scare off future investors because we're in there. And again, our job, I think, is to make sure that when we invest, we're providing the right level of governance. If we know a space, which sometimes we feel we do, and we've earned the right, we'll take a board seat and try to help management, both with everything from sort of go to market and product to, how do you run a business and get to a sort of a multinational scale. So no hard and fast rules. If I'm looking at something that's seed or pre-A, I tend to be very cautious about who's around the table, just because if I say, "Hey, I'd love this. I'd love 12 months exclusivity in Canada, let's say, or in this particular vertical market when I invest," I don't want to scare off other investors just because I want to be smart in that space.
Is there some way that you're measuring, in a sense, a successful investment? Is it getting sort of a lead time in advantage? Is it, I don't know, 40 to 80% of the deals end up being, include a commercial engagement? Is it, hey, this investment ultimately led to an acquisition? Talk to me a little bit about sort of the KPIs and sort of how
Yeah.
you measure which investments were most strategic and most valuable.
Yeah, two measures only for us: a rolling 3-year IRR and a what we call the value creation metric. And so that's that to us or through us. And we really optimize on that. We think that if we're doing business and we do it when everybody around the table says, yeah, we want to do this. It's not us saying you have to do business with us. If somebody doesn't want to work with us from a commercial perspective, it's not interesting. So those are the two measures. And I'll be just as blunt as I can. If I put $20 million to work and I got a 5x return on it, but did no business with TELUS, my boss would consider that a failure, which is kind of hard to hear, but it's the reality of what we do. And so, how do we measure our success? If we can get from, and we build these cases, we spend a lot of time on the cases. If we have sort of a value, or sorry, invested capital to value creation metric that we study. And so if the business case is, call it, $10 million over 5 years to the business unit, then we're comfortable doing up to sort of $20 million in an investment. So the idea is that if we start to build momentum, generally the distribution principles really, it takes care of the valuation for us. And I'd say that, a third of the portfolio is working really well in those terms. And then a third is in that sort of indeterminate stage. And then a third, we got it wrong. And, we're eventually going to recycle the capital.
So if the strategic value is there with a commercial deal, okay, that box is checked. What are the other things that you're looking at that might influence your decision to invest? Are you looking at the upside potential of the investment? Are you looking at the track record of the team? Are you looking at the overall sort of, let's call it a new horizon market size opportunity? It's just a big, big opportunity. What are the kinds of things that you're thinking about after you got a clear visibility to sort of a commercial relationship?
All of those will be in the mix. I think there's, again, that it's hard to remember, but materiality matters. In some businesses, and I've been involved in conversations with my boss where he refers to a a company is a startup and they're doing $80 million a year. And it's definitely not what you and I would refer to as a startup. So he's running a $20 billion P&L. He's got a different view of scale. And so we may look at something and say, yeah, we see it's a large potential, but one, we don't see it as a larger potential for us over the course of a longer period of time. Or we may look at it and say, actually, we want to buy this business. And so we tend to index on going a bit earlier, getting a bit more ownership, just to say, okay, if this is the opportunity to own this, we can, dollar average down by going in earlier. So we will always be upfront about our interest in acquiring a business, and we'll start by saying, look, like we like this space. We want to invest and work with you to build a business here. It's something that we care about enough that we think we might want to buy at some point. We'd like to have some additional information rights, etc. We all know the score on that, and we are very upfront about it. We're like, if X, Y, and Z occurs, like we should talk. We should talk about acquiring the business. And so that transparency, I think, also builds a lot of goodwill because they know you're in it to build a good outcome for everybody. And so that would be another factor in our decision making.
Initial ownership levels usually less than 20%.
We have this equity pickup issue that lots of people are aware of, and when you're a company like ours that has fairly consistent earnings, we are well known for producing our dividends. We are sensitive to money loss. So if we breach 20%, that's generally going to create some heartache if the business is losing money and we have to incorporate or consolidate. No offense to anybody who's an accountant on the call, but there is no hard and fast number, which means that I sometimes live in the 12 to 15%. If I throw in a contract, I try to be closer to 12. If I throw in a board seat, I try to really make it 12. It's unfortunately not a clear blue line, so there's a bit of fudging going on sometimes.
Yeah, understood. Okay, I wanted to ask you about sort of the characteristics of founding teams that you've backed. And, there's, the mantra of let's go out and find people that are hungry, humble, and smart, right? It's just, they're more fun to work with and they're oftentimes more successful. We've also seen that some entrepreneurs, I've been teaching a graduate school class on corporate venture capital and venture capital down at USC. And it's been amazing to hear some of the investors come in where I moderate sessions with them for the benefit of the students. And they talk about the importance of the entrepreneurs that they back having a chip on their shoulder. Really having, sort of, hey, it's them against the world. And sort of they come up with a vision and they recruit others to follow that vision. Is there anything that, we look at skin in the game and how much they've made as a personal investment or brought in through their personal network. We look at sort of, do they have almost proprietary understanding of a significant problem in a big market. We look at teams that try and balance sort of technical, finance, and sales and hope that they have, each one of those three core competencies. How do you look at sort of the characteristics of a founding team that you're going to back?
So I'll start with a simple lens and then I'll get more nuance. The most important thing I look for in a founder is their ability to attract and retain talent, and their ability to raise and deploy capital against a strategy. Like that's 101. I think where it gets interesting, and I think all the factors that you've talked about are certainly very relevant. I think the thing that we sometimes get wrapped around the axle on is we get very obsessed with people who understand the problem, or they have a deep sense of understanding of the space, but they've never built a technology business. And we sometimes index onto those people, and we all know that like building now the barriers are coming down 100%. Everything from cloud to AI is changing a lot of that. But at the end of the day, building a fully automated business, it's you wind up paying for somebody's education that a seasoned entrepreneur who's built a bunch of companies who just says, I'm going to go at this problem and I've got no experience in it. There's some benefits to that. One, they know how to build a business and they know how to deploy against problems. But and it can be sometimes helpful that they don't have the, I'll call it the biases of an industry that says that can't be solved. It's always going to be that way. So for me, I think the tricky bit is, if you meet somebody who really understands the problem and has lived it and has got all the scars from it and wants to build a technology business, do you back them? I tend to be on the opposite side and want to back somebody who's going to take on a problem which is highly understood and that's smart enough to figure out, like, okay, what are the limiting factors, as Elon likes to say, what's the control point here and how do we eliminate that? I think that's how we would sort of look at it.
Yeah, thanks for sharing that. That's helpful. Okay, we're to the rapid fire portion of the program, Terry. Maybe one last professional question that I'm curious about, and then two personal questions, if you don't mind. The professional question is sort of what mistakes do founders make when they're approaching TELUS Global Ventures? What's the pattern that you've seen with regard to mistakes made?
I would say, and again, like, I think it depends on what they're after, but I'd say that making the mistake that when they're talking to the venture team, they're talking to the business. I always encourage people to make sure that they have a business relationship. And, you know, the model that I referred to earlier, where venture teams like super smart people who understand industries and they can get great deal flow, and they come back and they're trying to force the startup into the mothership, I think is a really bad experience for a lot of people. Because I've seen companies destroy themselves trying to sell into, big corporates. And so the mistake is, don't make sure that you build, independent of the ventures team, a relationship with the business. And so that that the business leader or the product leaders in that business are trying to do the same thing you're trying to do, and they see value in you. Everything else is easy after that. You may not be a venture investable business. We can all try to figure that out together. But it's really thinking that when you find somebody who's smart in the venture community, and it's their job is to be out there, that you're talking to the whole of the business. And you'll see a lot of people who, I have varying degrees of relationships with my colleagues in the business unit. Sometimes they'll like pick up the phone, yes, let's go. And others are like, why are you bothering me with this? I got 40 things I got to do tomorrow. So I'd say make sure you understand the relationship between the two, the business unit and the venture group.
Does that mean as an entrepreneur, it's better to start with the business unit and have them be the source of the introduction to someone like you?
I Look, like, we can't control who we meet in the marketplace, but yeah, I would, if you come into a contact with a group like us and you're like, wait, I'm in digital health. I got this great thing that solves, neurodivergence challenge that everybody's got. That's great. The first thing you should say to Terry is, can I meet with the business unit? I'll be like, yeah, great. Absolutely. It makes my job easier, right? So yeah, 100%. Try to build that relationship and understand where the business unit wants to go.
Awesome. And last two questions for you personally. A favorite podcast or industry publication that you would encourage all investors or all entrepreneurs to track?
Acquired is doing an amazing job with like pulling apart industries that are technology, but also just businesses. I mean, their overview of LVMH is probably one of the most astounding things I've ever listened to. And they're both investors. They know how to pull apart a business. I enjoy it a lot. The long, great one on the NFL that I just listened to recently. But I also try to listen to stuff that has nothing to do. Like, I'm a bit of a policy wonk, so I listen to a lot of, I'll call it foreign affairs work, and smart people talking about how the world is evolving outside of technology. So I spent a lot of time listening to things like the President's Inbox, the BBC World Service. Having lived in the UK, I have a bias. So those are the kinds of things I like to listen to.
Awesome. And then last question for you. When I went through the Coffin Fellows program, they have something called a thought leadership project that you work on during your 2 years. I did mine on strategic planning for life, sort of how you apply business tools to your own life to sort of measure how things are going. And I ended up publishing a book recently on it. A big part of it is how you start your day each day, morning routine, trying to understand. I love crowdsourcing information on how people start their days because I think it does establish the trajectory to how that day is going to go. So anything interesting you do in the mornings to sort of kickstart your day?
It's actually the time I've learned through years of experience that it's actually the time when my brain is most receptive to absorbing information. So if I have my team is very comfortable with producing 20 to 40 page decks on a regular basis on deep topics, it tends to be the time when I read them. I've got no distractions. I've got, I'll call it, my brain is at its freshest, and I tend to absorb best and I think more clearly. It's also a time, if I'm not doing that, where I exercise. And that's for me, exercise has always been a way to manage stress and we'll call it sleep interruption because I spent a lot of time on a plane. So it gets me back into a more regular pattern, but it also involves the opportunity to sort of process problems that I'm thinking about. So it tends to be my best thinking time is in the morning.
Thanks for sharing that. I appreciate that. On behalf of the team at Saracap Impact Venture Capital and the Kaufman Fellows, thanks to Terry Doyle for spending time with us. Really appreciate you, Terry.
So very happy to be here, and I really love the work that you're doing. Keep it up.